Hi everyone, welcome back to Wednesday Moves. This is episode 12 of our trading education series. Today we are going to talk about two things that matter more than any indicator: risk reward and position sizing. If you understand this properly, you already have an advantage over most beginners. Why risk comes first? Many new traders focus only on profits, but professional traders focus on survival first. Protecting your capital is what allows you to stay in the market long enough to improve. Understanding risk reward. Risk reward simply compares how much you are risking to how much you are trying to make. You should always think about this before entering a trade, not after. Example 1 is to 2 risk reward. In a 1 to 2 setup, you risk 1 unit to make 2 units. This means even if you lose some trades, your winners can still balance your results. Why win rate isn't everything? Many beginners think they need to win most of their trades. In reality, good risk reward is often more important than a high win rate. It's about quality, not quantity. What is position sizing? Well, position sizing means deciding how much to trade. It is based on your account size and your risk, not on emotions or confidence. Risk per trade rule. Now, a common guideline is risking only 1 to 2% of your account on a single trade. This helps limit damage during losing periods and it keeps your account stable. How to calculate position size? Well, position size depends on three things: your account balance, your stop loss distance, and your chosen risk percentage. Calculating this before every trade builds discipline. Common beginner mistakes. Now, some common mistakes include trading too large, trying to recover losses quickly, and ignoring risk limits. These habits often lead to unnecessary losses. Risk management mindset. Well, good risk management is more about mindset than math. It requires patience, consistency, and emotional control. This mindset develops with practice. Simple trading plan example. Now, a basic trading plan includes where you enter, where you exit if wrong, where you take profit, and how much you trade. Writing this down helps remove guesswork. Here's a key takeaway: always protect your capital first. Growth comes later. Long term success is built on controlled risk. That's it for today's lesson. If you're finding this series helpful, consider subscribing to continue learning step by step. Thanks for watching, and I'll see you in the next episode of Wednesday Moves.